Hi everybody, I'm Lynette here. We're very pleased to be part of the 2021 Singapore FinTech Festival. One of the topics we'll be covering over the next few days will be the relationship between sustainability, ESG, and the FinTech innovation space. As a venture lead for SC Ventures that focuses on advancing ESG integration standards and spearheading collaborative ventures with industries, this is a topic very, very close to my heart. Today, we'll be looking at how ESG compliance in financial institutions and organizations is more than just fulfilling an expected societal responsibility. It can create value for financial organizations and results in much better financial performance, societal responsibility, and very much beyond. So the banks have led the way to set global ESG standards with the Equator Principles first established in 2003, which is adopted by 123 institutions, and the Principles for Responsible Banking signed by 130 banks in 2019. Banks are becoming more and more aware of ESG issues, and we are still struggling with how to accurately report data or tell their stories based on these issues. The EU also has taken note that it's essential to improve the way ESG risks are measured and managed, and to improve the possibilities for the markets to monitor and assess banks' activities. So for today, we're very lucky. We have both Constantino and Vikram from EY Parthenon in Singapore here with us to discuss much more and provide invaluable insight on this topic. So over to you guys. Maybe a short introduction.
My name is Constantinos Dimitriou. I've been with EY Parthenon for about 5-6 years now. I'm an associate partner. I mostly work with private equity clients and energy firms. And we've been looking deeply into this topic over the last 2 years, and I'm very excited to be here to talk to you about it.
My name is Vikram Chakravarti. I'm the managing partner ASEAN for our strategy and transactions practice. I'm also the global strategy leader for our EY Parthenon practice, which is our strategy practice across the world. Lynette, thank you so much for having us here. Do I get started?
Yeah, maybe you can share a little bit more about how you guys started your journey with EY and how did you get into ESG sphere before starting the presentation. That would be lovely.
Well, for me, I met Vikram, and he surprisingly thought I should be part of the team about 6 years ago. It's been a great journey. A lot of my professional history in the background was working with financial institutions, private equity clients, and energy firms around the region, and in fact across the world. So most of the topics that we've been dealing with my team over the last 6 years at EY have been around energy intensity, and obviously private equity across the board, across industries, both on the due diligence and exit readiness side. And over the last couple of years, ESG has become a very key concern for the GPs we work for, and coming from their limited partners, and also especially for our energy clients who have had to adjust very quickly to a rapidly changing landscape that traditionally they were not prepared for. So I think that's kind of how the topic has made its way into my work.
Thanks for sharing about how you got into EY and how Vikram got you involved. And it's not surprising at all, and really wealth of knowledge in the energy space and in finance sector. How about yourself?
Lynette, I joined Ernst & Young about 7 years ago. I was brought in to build the strategy practice locally first and then globally. We came late to the ESG topic, right? Sustainability wasn't part of the frame of strategy discussions for a long time. But I would argue that for the last couple of years or so, it's made its way into the boardroom and become a real megatrend that we need to put our arms around. And as the global leader of the strategy practice, I encounter clients across the world. And one of the things we've been talking about, apart from digital, has been ESG topics. And I'd been worried about the way clients had been thinking about it. I felt it was too fragmented, too wide-ranging, less focus, etc. And that's part of the reason why we created an internal team to start thinking about this. We've done a lot of meta research on this, and we'll share some of the research findings. But the critical takeaway from our standpoint is, we're pretty hard-nosed business folks, right? And while we want to do good, we also believe that to do good to perpetuity and in a sustainable and structured way, you need to be able to link it to value.
course.
And I think we share some of our research today, but this is something that has become core part of our strategy work. So most of our strategy work today is around 3 real buckets. We do a lot of digital strategy work for our clients, as you can imagine.
Yep.
We do a fair amount of work around turnaround, cost reduction, etc. And then the third piece is around ESG, where we've done, as I said, we link it to the core piece of strategy and therefore link it to value of the organization.
That's fantastic. You're actually bringing the contextuality, the materiality of ESG together, tying in with the 3 Ps, people, planet, and profit at the end of the day. Yeah, yeah. So it's great. I do understand that you guys have prepared this beautiful presentation, which is going to be so informative. Shall we dive in?
Yeah. Let's just take you through a little bit on. There is a lot of depth around this, Lynette. So we we won't be able to get into all of that. And obviously, if there are good questions, we're happy to handle it here, and of course, take it offline as we go along.
Yeah.
I think this is very pertinent time to be talking about this. Right? COP26 is finished. This is top of mind. And as I said, one of my tasks on a daily basis is to talk to board members, global CEOs, and policymakers across the world. So I have the luxury of speaking to somebody from Germany in the morning and somebody from Japan in the afternoon, etc. But one of the things that has really taken us, really sort of gripped the imagination at the boardroom level and the C-suite, coming out of, I think we could have the next slide, please, right? Are what we call the mega trends, right? When we talk to our clients and board members, we essentially trying to set agendas at the boardroom level, right?
Yep.
And from our standpoint, there are probably a few that are absolutely critical to tackle. The first one is the rise of digital, AI, data, etc. And while most companies know that this is important to do, exactly how to go about this process is difficult. I know you guys are digital native and digital first. I would argue that many of the people I speak to come from traditional businesses, and for them to make this quote-unquote great leap has been a tortured journey, right?
It is. It's one of the big pain and problems. It's not just end bite is actually a big pain, a huge cut that needs a huge bandage. Yeah.
Spot on, right? And while we can look on with admiration and perhaps a little spot of jealousy with the valuations and the growth of the digital native companies or digital first companies, the traditional businesses are actually still a very large part of the economy.
Of course.
And it is super important for them to pivot and be able to do something different. So digital is one very big topic, and there are some similarities in the way they think about digital and ESG in terms of the cost of doing things, the uncertainty about the outcomes, and the fundamental change management that has to go through. And I'll try to link these conversations as we go along. The second big piece, and this is interesting, I mean, this is certainly very true in America and Asia, maybe a little less so in Europe, is the geopolitics that's playing out and the dislocations between the US and China. I was having lunch with a very wonderful professor yesterday, and he was saying that until a few years ago, it was very common for kids to be wanting to study both in the United States and China as part of their college degree, right? And he said in the last 2 years or so, it's almost come to a grinding halt. Look, I don't have a specific comment on this, except that the reality is most companies will have to find a way to manage through this dislocation, and we do a fair amount of work in this space. The third topic, and this is the one that actually took me by surprise, as I said, I had not I expected health and wellness to play out because the first concern for most CEOs was the duty of care towards their people who worked in the company. But the ESG and that propelling up, sustainability and that propelling up, took me by a little surprise, right? But it echoed pretty much consistently across the world. There were different topics around this, I would argue, that if you looked at Europe as a whole, when they talked about ESG, it was really sustainability. Germany especially, you get a lot of sustainability-related discussions.
Yes.
In America, it changes a little bit, but there's a lot around the societal aspects, right? So Black Lives Matter, if you recall last summer, gripped boardrooms across America, right? And it is a very delicate role to play because it has multiple aspects around it that we had to contend with, right? In Asia, it's interesting, and I'm generalizing, obviously, but in Asia, the ESG from that respect, either is sustainability or it's interesting, there's a lot of nationalistic, what can I do for the nation building type of conversations that play out, right? But nonetheless, it has become a super critical topic at the boardroom levels. Could I have the next slide, please? What's interesting is that unlike many other trends, people are voting with their wallets. So we actually are seeing significant amount of dollars and cents going towards impact investing, sustainability investing, ESG, etc. Right?
Yep.
So there's a flood and a tidal wave of money coming towards ESG. Let me give you a sense to this, right? Last year alone, I think about 170, 180 odd billion dollars was allocated towards impact investing,
Yep.
up almost 3 or 4-fold from the previous year. What's interesting is this year we well crossed that by the end of July. So the amount of dollars that is going towards this, and you have all manner of people investing. State pension funds are willing to think
Yep,
about
pension
this, right?
funds are big on it.
Savvy hedge funds are doing this, and folks like me who are individual investors are also thinking about what it means from, I want to vote with my conscience in some ways, right? So the flood of money has come way ahead, even if you ask me, from where firms are in being able to catch up with this tidal wave, right?
Yep.
So next slide, please, right?
It's
And
grown a
this
lot.
is-
It's grown a lot over these 2 years.
Oh,
particularly,
absolutely, right?
Yep,
So
deep
the
and
money is
bounce.
flowing in. It's become a critical topic at the boardroom level, right? And this is where, and this slide sort of captures where my discussions end up with the boardrooms, right? We basically go back and trace the history of ESG and ESG related topics, and you realize that philanthropy is around for, since the robber barons, right?
Yes.
And that's been around for a little over 100 years or so, in a sustained way from corporates. Corporates giving money towards philanthropy has been around for a long time. And I think in the last 30, 40 years, it took the form of corporate responsibility or something like that, CSR type
Yes.
of initiatives, right?
Yep.
And there was all legitimate and relevant things to do, but the reality, if I may, was it was a small rump of money allocated to on the side, and there was an annual exercise where, the corporate satraps came down, shook hands, and had a photograph and a photo event, right? And while those were all good things to do, in reality, there was no emphasis of bringing that into the core of the company. Nor was there any appetite to increase the funding towards CSR in a substantive way. But perhaps critically, there was no link between what CSR activities were done versus where the company was. These were essentially two delinked processes. There might have been some, right? But in reality, this was doing good, right? This was basically people assuaging their conscience and doing good to a large extent, and a couple of percentage points on revenue would be allocated there.
Yeah. It's a bit like a window dressing, but not having the windows in place.
Perhaps, right. I mean, I do think CSR
But it has moved
initiatives
on.
were
It has
very
moved on.
helpful,
Yeah.
but it did not link with corporate strategy. And that's when we get involved, right? So one of the things, and I have a global team that looked at this, we essentially challenged ourselves to ask ourselves, can this carry on? Or if ESG is such a pertinent and critical topic at the boardroom level, do we need to link it to value? And if you can, therefore, crack that code, right? If you can link ESG activities within an organization to value, then would you be able to create a more sustained and structured effort within the organization around ESG, right? That was the question we asked the team. And Cons is the core member of the team, so he'll take you through the journey of what we found. So essentially what we said was, while we're happy with the CSR, we're trying to now get to ESG linking with value. And if you're able to do that, then it should be part of corporate strategy.
Yep.
Right? It is not different or a stepchild or a window dressing, as you put it, right? It becomes structured what we want to do with our organization. And we knew that this was important because, as I said, the flood of money. So my opportunity to talk to both policymakers as well as the large mutual fund managers, etc., they were all clamoring for this need, right? But I knew at the corporate level there was a dissonance because they did not know whether this should be, how they could make it as part of their corporate strategy. The next slide, please. And it's not, and my heart goes out to people who are trying to solve the ESG conundrum, because not only is ESG extremely wide-ranging, right? It's ever-changing, and it's fundamentally contradictory. You could do one piece here, and you could solve something on one of the ESG platforms, but essentially hit something else. So let me give you a simple example, right? Let's say you and I owned a coal plant in a small village, right? Where everybody in the village was dependent on working on the coal plant, right?
Yep.
If we shut the coal plant down, you and I would get points for environment, right? Because coal is polluting and therefore very good for us, right? Yet at the same time, we would be making that entire village destitute because we've robbed them of their livelihood. So ESG is too wide-ranging. It is just complex, and every day somebody throws something in there. And if you read the academic literature on this, right, people are completely puzzled about how to tackle these because each topic is complex. How does it link with whether does a company have the responsibility towards that topic is unclear, and exactly what they should do, how much they should do is all very unclear, right? So this is the conundrum that we try to link. And as you can see in the way we frame it, and I'm sorry we come across as little businessman types, but that's our job, I suppose. That we said, fine, we will not be able to get to the bottom of this unless we link it to value. Now, there may be other people out there who might be able to link ESG to goodness, happiness, utility, etc., and I wish them well. But since we do most of our work with companies that are trying to make a little money, we'll try to link it to value. Next slide, please.
Agree with you. Coming from a bank, we have to link it to value at the end of the day, right? That's one of the biggest drivers. Yeah.
Glad to hear it, right? So as things stood, I mean, and I haven't, we've been careful about not telling you who these quotes come from, but these are all quotes that I heard through my conversations. So as I said, when we have these conversations, people came back and said, should I do this or not? What is ESG? What risks are there to manage? What matters? How much matters? Because there are too many things in flight. As I said, in Germany it's something else, in the US it is something else, in Japan it's something else, Singapore it's something else. How do you know which one is most relevant? It wasn't clear. And if I do it, how much should I do it? Yeah. How much ESG should I do, right? So we wanted to penetrate through this fog with a very clear attempt to link ESG activity to value. And if we are able to do that, then how much to do becomes less of a question because you should do more if you're able to link it to value, right? So that was our hope. Can I have the next slide, please? And this is where these are the sort of questions we will try to answer in today's presentation, and Cons will take you through this. But essentially it gets to the heart of, should I do ESG or not? Number one. What part of ESG should I do and what kind of trade-offs should we do? Let me give you an early answer to this. We have the ability to diagnose this at a company and a sector level to tell you what part of ESG to focus on. And one of the things we talk about very openly in our strategy discussions is that if you're going to focus on this means deprioritizing other things or indeed explicitly making choices and trade-offs and communicating that. Now, whether those choices and trade-offs are with other ESG platforms, so let's say, for example, you and I decided to shut the coal plant down. That means we are voting very clearly on the sustainability of the E part, right? But we are saying that there is a trade-off, and we acknowledge that there is the downside impact on the S side, on the societal part, right? So we talk about that. Some of these trade-offs could be financial. I want to remind people that ESG is expensive. There's a fair amount of capital that needs to be invested. Oftentimes, the margin profile of these activities are slightly lower, right? And therefore, this is a complex discussion, and we talk about these trade-offs very openly. Yep. That gets to the third piece. How much does it cost? Reality switch from gas-fired to, let's say, solar or a wind, depending on the country. You know exactly what the parity levels are. But in many other places, it's not well understood. And we have a very good way of getting to the heart of how much it will cost and what kind of changes. And this is important to note, Lynette. The changes, if you are adopting ESG, it's not just the cost of doing something, right? And you walk away from it. The reality is that many, many, many steps have to change. The way you've operated has to change. In this particular space, I would argue that there is a similarity with digital adoption.
It is.
That it's not just money that you need to allocate and potentially a lower margin profile or indeed a cannibalization of your old businesses. In truth, you also walk in with the fact that all the ways of doing business, your quote-unquote business model, will be disrupted and changed, number one. Number two, people will have to change, so you have to embark on a massive transformation process. The point I want to make here is this, that this is not an overnight journey. That when we work with clients, we fully expect that this is a longish horizon, is where you will start seeing the full range. But the ability to address that upfront, explicitly communicate trade-offs, and then work through on a calibrated journey is something we work on. Lastly, we talk about how big you should go. If you're able to link these to value, then you should be able to get a better answer on how big you should go. I'm going to hand it over to Cons to take you through some of the meta research we've done. There's a lot of depth behind this research, right?
Of course.
And Cons leads the global team that did this work. I'll hand it over to you, but we're happy to engage in all manner of discussions beyond this.
Thank you so much.
Great.
That's a very good discussion on how measuring and managing the impact and also the transformative journey and building the whole DNA. And Con will take us through the whole portion about the money part and the risk portion, and that is something that we all actually want to know. Yeah. So we got the drivers and how we're going to manage it.
Just what's one thing, Cons, maybe you can start with the MSCI index and how we use that in our meta research, right?
Yeah, I mean, I think Vikram walked us through the journey of 4 sort of questions that need to be answered at the board level to start with. And I think I'll start with a question of whether one should embrace ESG or not. And a lot of the research done, not just by ourselves, but other sources, including MSCI, who integrate ratings on both returns and ESG performance, is that there is a cost of capital advantage to leaders in ESG. What does that mean? Especially in our region, we're finding that end consumers are not always open or willing to pay for the ESG premium. However, we do note that there are investors on the capital provider side that are willing to pay a premium for companies that are high performers of ESG, because the universe of these companies, whether you define it through the MSCI or any other index, is limited versus the capital that's pursuing them. So we do find that in emerging markets, there is in emerging markets about almost a 1 percentage point difference in WACC between the worst sort of performers in the bottom 20% to the top 20%. So why should you embrace ESG? Because there's clearly, if you can demonstrate clear leadership, not just on paper and by ticking boxes, but through the due diligence process, there is a cost of capital advantage to it. So even if you may not be able to realize it in your end prices and margins, you would be able to realize it into your valuation. So next slide, please. However, back to Vikram's point is which part of ESG should we focus and what are the trade-offs? There is also a guiding sort of set of principles, and it goes by the name of materiality. So every sort of, there's a proliferation of frameworks for assessing the ESG quality and performance of a company, and there's a proliferation of frameworks. But whichever framework you choose to pick your materiality or sort of pass the materiality for, you should always look at it through the lens of investors. And investors are very clear on the priorities that they see, and usually that comes from a sectoral lens. So we're here sitting in a financial institution and talking about fintech. In financial services, product labeling and representation is a very key thing. Risk management is a very key thing. Those are less important actually than greenhouse gas emissions. Obviously, banks do not emit as much greenhouse gases as, say, a power station. So there is a calibrated and assessed over time sense of what matters and what doesn't, and that does depend on the sector you're in. So pick your framework, pick your battles, and focus. And the next slide will tell us why. It's because investors have observed, and this comes from research that's published in the Harvard Business Review by the Harvard Business School Finance Department, Accounting and Finance Department, is that the track record over the last, I believe, 25 years demonstrates that companies that focus on the material topics and don't try to be everything to everyone, but the ones that are focused demonstrate the highest alpha. So they have demonstrated the highest risk-adjusted returns for investors. Investors know that, they've seen that, and that sense of focus and commitment is a signal to them that this company means business. And it's not just a ESG topic, this is a management topic, this is a leadership topic. It shows that this is a company that's led in a way that appreciates trade-offs and places its bets where it matters. So companies that ignore ESG have lagged. They have negative alpha. Companies that focus on the less material things, they pretty much track the beta. They demonstrate minor levels of alpha. Companies that spread themselves too thin, doing everything, 2% alpha, trying hard, but not focusing the resources. Companies that focus on the material, high alpha. So that's why you need to pick your priorities carefully. But if we go to the next slide, things are not straightforward when you just look at the P&L. There's going to be cost, there's going to be capex. Typically, some performance metrics on average tend up being higher for ESG leaders. That is possibly because ESG leaders also tend to be better run companies. But I think the key finding here is that outcomes on the net income margin or the net income line are mixed. And the top firms have, on average, lower net income margins. But, and if we go to the next slide, the cost of capital advantage and overall profile and growth of the company compensates for that in valuation. So what we observe, and this is a sort of back on the envelope, so to speak, sort of calibrated yet informed calculation of the difference that the cost of capital does to the valuation multiple of a company. An ESG leader that gets a step up versus a competitor in the lower quintile, an ESG leader that has a 1% WACC advantage or has an additional 2x in its enterprise value to EBITDA multiple, which is material for investors. So doubling down, focusing on what matters actually makes its way into the valuation, and you can see it in the multiples, and we see it. We just completed a piece of analysis yesterday in the seafood space, and that trend does hold out, does turn out again and again. So in the interest of time, I will just very quickly go to the next slide and talk about the poster child of this transformation, Ørsted, which is a Danish, used to be an oil and gas company that performed a fantastic transformation over 6 to 7 years to become the world's largest wind farm and most successful wind farm developer. They went through this journey. It's very easy to write it as a case study, as being a linear progression through these steps. In reality, it was a painful, long, deliberate, and quite frankly, stressful 7 years for the management, the board, and hard choices had to be made. The result of this, if we go to the next slide, has been outstanding returns. So the effort and the work paid out with an immense amount of overperformance over the comparative indices, but it came with commitment. So I will close by saying two things. First of all, on the next slide, if we don't mind, we support clients across the life cycle of deals. Before clients consider an investment into a company, we help them assess the ESG angle along with the commercial, financial, and other aspects of the deal. During the holding period of an asset, we help companies, and we're currently helping a number of companies integrate ESG into their strategy. ESG is a new dimension, but the tools for corporate strategy making remain relatively unchanged. We help them take that journey. And through exit, we also help position assets with the right story and metrics on ESG. And closing with the last slide, we do that by following 4 golden rules. Considering all the time that materiality is critical, don't spread yourself too thin. Ensuring that the upside gain is larger than the costs incurred, and for that you need to have a valuation view, not a P&L view. Communicating effectively to the market, which is measure, report, be transparent, and continuously focus on what your investors are telling you and your stakeholders. And finally, go big and go home. This is not a box-ticking exercise. This is something you need to double down on.
Yep.
That's where we are. I hope that makes sense, and
It
I
does.
hope we
It does.
do not overrun too much.
No. I think it's a very good discussion that you have actually shared about it. I love the fact it's building in the DNA. It's not so simple and straightforward. We set materiality matrix, we do the materiality assessments, but it's so widespread. We can't just copy what other industries are doing. They act as a benchmark, is a good guidance, but like you guys come in and tell them, hey, we got to focus because the results show, right? Like what you said, the 6% that has done a lot better were the ones that have actually picked on what they have chosen to focus on and stuck their guts through it throughout this whole period, and they have the results to prove for it at the end of the day. So that makes a lot of sense. Yeah, great presentation. I think it was a good summary of the drivers to go into the space, what should be done, and manage your expectations, and take measurements and manage whatever that you're doing to map back according to what you have set up. Yeah.
Absolutely. I mean,
great.
so from our standpoint, is that this is a fundamental strategic choice, right? So we're moving the conversation away from doing good to actually this is going to be a strategic choice. If that is the case, then pick the bits that you need to do, ignore the bits that you will not do, explicitly communicate that, think about the costs of doing this, think about the margin profile, and therefore make sure that as you're doing this, you communicate explicitly to be able to get some of the offsets from the capital markets, also, being able to raise capital as you go along. But the idea here is that you must do it, you must pick the right pieces and then do it well, and yet at the same time making sure that since you will be at it's a costly venture, you need to make sure that you're able to communicate effectively to be able to get the capital markets offset.
Yeah, of course. It has to be woven into the corporate strategy.
Correct.
It's not just a side dish on the table. It actually has to be woven in. And to make it worthwhile being woven into your whole corporate strategy, you actually need to create the value creation beyond it and to be aligned with the rest of the economic market. Yeah.
Of course, we hope that this is a virtuous cycle, right? That if you do the going big, so to speak, you're also getting the offset. This then gives you the courage of confidence to go back and do more of this. And then this becomes a self-perpetuating virtuous cycle as opposed to a CSR initiative, which oftentimes are trapped with the budget and never become core of the company.
Agree, totally.
So that's our thinking.
Yeah. No, it's great. And you guys are doing this in the workplace, which is making a lot of sense, advising the global companies what to do next, guiding them, and which is what a lot of the companies require. We need to know where it streams in. Do we have that?
Do we have questions?
There is, but I'm not getting it from here. So does it usually pop in from there?
Show up here?
No, it's not showing up here. Nope. Nope. Nope, I'm not seeing anything from here yet. Yep. Nope. Refreshing. Ah, hold on for a while, is it?
No problem.
Okay, that's
No
fine.
problem. But you make a good point, right? So we're actually serving a large number of companies across the spectrum. You can imagine that the energy companies that Con serves are obviously very much in the crosshairs, so there's a lot of activity there.
Yep.
But we're actually working across multiple sectors, right? So we're doing a lot of work with real estate companies as they think about greening of their buildings. Now, that sounds easy to do, but it's quite expensive. Consumer products are also playing this game. I would argue that a lot of the emphasis has been spent around packaging so far. But as we get into the depth of consumer products, we've realized that health and wellness is actually a critical ESG component as they think about it, right? Yeah. So reducing sugar, reducing salt, etc., has become part of the consumer product companies' mandate. We're doing a fair amount with industrial companies, and here we think a lot about Scope 2 and 3 emissions and how do you manage that. So there's a lot of work that's going on across the spectrum. The bit that Cons referred to was also interesting, where we are doing a lot of work with companies that are trying to put money into organizations to assess the quality of ESG. So not only do we do standard ESG strategy work at corporates, but also help think through how do you allocate money, and which companies are going to be the winners and losers, etc., on that profile.
Actually, those are very, very interesting areas. And in fact, like what you mentioned, health and wellness, which crosses over between, actually, I would consider larger than beyond the health wellness, is that how do you actually take into account the quantifying it, and how do you validate it versus a lot of the environment is very much easier nowadays. The carbon credits, the emissions, we have so many calculations. In fact, we have so many frameworks and standards in place, right? So the
question up, and then I'll get Cons to respond to this. If you look at ESG, right? If you look at ESG, the E part is probably the best defined in terms of how do you measure, etc., right? So it's solved, right? Because governance in most organizations across the world are reasonably getting better, and at least conforming to certain standards and guidelines that we understand.
That's the one part we can tick all the tick boxes usually.
That's correct. Right, that's correct. The governance aspects, broadly speaking, you know what you're looking for, right? And if you look at people with low CRAP, right? And the MSCI index gives you the metrics, And there's actually a very elaborate system. What is it, 160 odd parameters that you can look at to build up your thing, right?
Depends on the framework, yeah.
Yeah, in the framework, right?
Frameworks, yeah,
So
it's
there's a
quite a lot.
very detailed framework. We actually get into the details of that. So we have a team within EY that actually measures how ESG and against the MSCI index, etc., for reporting purposes. So we have a team that does it from a reporting standpoint, and we work very closely with them to be able to expand and expound on some of these social aspects that you were referring to.
Oh, it'd be great to see the progress along the way, and makes a lot more sense when it gets more quantitative. Yeah.
I think also on health and wellness, there is there is a tool set in the sense of the, I mean, the gold standard is the randomized clinical trial, but the, studies and trials of a smaller scope and smaller scale are the starting point or building block towards that. So if you're making claims or you want to assess the impact of your product and how improvement of the product would get you outcomes in health and wellness, you can pursue a science-based approach to it. And the tool set's there, and we can take that from the clinical sciences. So in that particular sector or field, I don't think it's as much of an issue as when you enter questions about race, about equality,
Those are the
about fairness. Those are the difficult questions.
Yeah.
Yes.
Cons, there are some questions that are coming through. Why don't you take a bash at them?
Okay, so the first question is, what is the return on investment of ESG? I think that is an interesting question, but I think the answer to it is please reach out to us and we'll have a chat about it, because it depends on who you are and what you're trying to do.
But we can talk about the offset, right?
Look, I mean, as we said, a focused play. Look, if you take a bottom quintile player with a very, it depends on the parameters of your firm, how much your firm is worth now, what your growth profile is like, and what your valuation is, right? And then you have to think about, what does ESG mean for me, and what does this mean about my strategy? Which product categories will I grow in? Where do I need to put in investment in order to reduce my footprint, for example, or in order to sort of align societal impact of my products with where I need to be? And then you have to calculate the impact that this does on your margins and on your cost of capital. And then you will get your firm's return on investment on ESG and the impact on your valuation. The example we showed earlier was for one case in an emerging markets context where you can get a step up of 2x on your existing multiple base. But there is no one answer. It's not ROI on ESG is 10%. It depends who you are and where you are and what you're trying to do.
Yeah. I mean, the hard truth is that most ESG initiatives within an organization will not meet the standard hurdle rate. But if you do this right, then there is an offset in the capital markets, and therefore you can talk about that. Right?
And you may not even need the capital markets. I mean, for example, if you're in manufacturing and your plant is wasteful, and you suddenly start thinking about waste as a real cost that has to be mitigated, you might be driven, and there's many case studies of this since the 90s and studies done, that a reduction in waste and pollution can also lead to higher return on invested capital and incredibly low payoff times, like less than a year or 2 years for the capex put into the ground, because your process is now more efficient. So again, it's not a cut and dry, it's like you will have lower margins by necessity and therefore you need the capital markets to reward you. It depends on your case, your situation, and your starting point. So it's a very hard question to answer on such a general level.
Get to the next one.
On the
It's an easier
second
question to answer.
How can you measure the value you're creating? I mean, that's what we do for a living, right? What we do is we typically enter a situation where the client has some form of an idea of the strategic options or a strategy, and what we do is we help them cascade it down into initiatives, right? And what we do is we take those initiatives one by one and we expand them into a tree of initiatives. What I mean, without getting too technical, is, pursue growth in certain product categories. Okay, so then what does that mean? We need to to invest more money on product development in these categories. We need to increase our marketing spend in these categories. We break those down, we allocate them, and against each of them, we can estimate the NPV. We can estimate what the value impact is. And we follow this rigorous process. We give ownership to each of these streams, and we track the value created over the lifetime of a project against each of these. And this doesn't change with ESG. It's the same approach.
So simply put, right, if you do this well and you do it large, then there is probably a 2 points of EV over EBITDA multiple increase, right? So if your sector is trending at, let's say, 10 or 12 EBITDA multiple, you can get to 12 to 14, right? So there's a clear and distinct way for us to measure your value.
Yep.
And Con is talking about the internal process. The market also gives you a recognition of doing this right.
Yep.
Any other questions?
Nope, I didn't have any other questions. And actually, we kind of overran the time a little bit, but I think it was a very, very good discussion. We actually do realize the importance of measurements, because only with that we can manage. I'm glad that you guys are taking the lead in the space to actually look into the risk and how to tie back to the value. I think that's very clear. It's not about just doing good. We want to actually create value for the companies and be part of a global system. At the same time, minimizing the damage and impact that we can create. And that's very important. And it's great to see you guys in the space itself. Yeah, thank you for your time today. And yeah, so I think we shared a lot, and really appreciate the time that Constantino and Vikram has taken to join us here today. And please look into our FinTech Bridge. This broadcast will be back on LinkedIn and on FinTech Bridge, and you can take a look at the other FinTech Festival podcast that we will have over the next few days.
Thank you for having us, Lynette.
Thank you so much for your time. Good discussion. I enjoyed it.
Thank you.